The American housing market is falling apart. This could be bigger than the 2008 crash as the prices are falling much faster. Join us today as we investigate the current housing market conditions in America. In just a few months, the pandemic housing boom has turned out to be a big bust. Reports are showing that home prices are now falling faster than they did during the 2008 financial crisis. Prices are falling more than 4% per month. 30-year fixed mortgages are at 7.3% and rising after the recent Fed meeting that was held. Now in these situations, mortgage applications for purchases are considered to be the best indicator of future sales that will close in the coming months. Even these numbers are down by 42% year over year and continue to fall each week. And not only the demand is decreasing, but there's a flood of new homes that is about to hit the market, with over 1.7 million privately owned homes currently under construction. And some recent economic models will tell you that compared with sluggish wages and skyrocketing interest rates, home prices are as much as 75% overvalued in the already hot housing markets of America. This developing crash in housing prices has great implications for anyone who's looking to buy a house, as well as for investors in housing stocks. Now it even warns us more that the U.S. population was growing by nearly 3 million people per year in 2006, but now the population is only growing by somewhere between 500,000 and 1 million people per year. At the average of roughly 2.5 people per household, that implies a need for nearly 1.2 million housing units that were built in 2006, but in today's conditions only 400,000 units in 2022. But we're about to get hit by 1.4 million houses that no one will need, if we assume we gained 1 million people in population. And there are obvious reasons to believe that population growth could be even lower in future, as declining inflation-adjusted wages and declining life expectancy due to diseases like coronavirus, opiates, general malaise, etc. And we should ask the question, with mortgages over 7% now and population growth flatlining, who is going to buy all of these homes? Now, even though prices have skyrocketed, housing units per capita also exceed the levels seen in 2008 in many markets. But the thing is that this doesn't mean that housing isn't scarce due to booming demand or too expensive. But what it does mean is that supply has easily kept up with the growing population. And the data shows that the U.S. population aged 16 to 54 is actually now falling. Now, prices of these houses have surged, while the employment remains well below pre-COVID-19 levels. This is not the free market since 2019. Instead, it was from interest rate suppression. Now that rates are skyrocketing, this is a huge warning for all of us. Yes, prices should increase as per demand and the supply, but the degree of price that's rising while construction of new houses keeping pace with population growth should not happen. The inflation, wages not increasing, all these factors don't fit with the enormous boom in home prices, which is why many economists believe home prices are too overvalued. What's really at play here is that housing prices have done nothing but go up because the interest rates have gone down, fueling round after round of speculative buying of the houses in the market. But with an ongoing construction boom of 1.4 million houses well above the population growth, the question is who will live in all these houses 5 years from now, 10 years from now, and 30 years from now? The crash of 2008 showed that even markets with good long-term fundamentals tend to see crashes just the same because they receive an excess amount of speculative investment inflows. For example, Tarrant County, in the Dallas-Fort Worth metro area, saw 52% of all home sales go to investors last year. If you ask anyone, isn't that the height of insanity? These numbers suggest that in a county with over 2 million people, less than half of home buyers actually intended to live in the houses they were buying. And this is after in the last 10 years, when the median income in Texas rose well above 29%, while the median mortgage payment on a new home purchase has risen more than 280%. Home price gains of this magnitude are created by borrowing, not actual wealth. And while everyone's talking about the US, enormous housing bubbles are now common globally, mainly in countries like China, Canada, Australia, and New Zealand. In the 2000s housing market bubble, America and much of the world had a cultural moment where real estate was praised as the only real way to build wealth. And after the 2008 crash, all these people got disillusioned and decided that being a homeowner wasn't worth the hassle. From late 2019 to early 2022, a similar craze took hold of people again. But now, demand is truly tanking again. With mortgage rates over 7% and prices up substantially since the pandemic, this is perhaps the worst time to buy a house in our lifetimes. And this is coming 10 years after the best time to buy a house in our lifetimes, and likely 2 to 3 years before a similar time may come again. Mortgage applications are down 42% year over year. That's simply stunning, considering how people were getting into bidding wars just a month ago. One reason for this could be the fact that if you would sell a house to buy another one, that's not net housing supply. But if someone passes away and their kids put the house up for sale, or if a couple gets divorced and rents, or if investors sell because they realize that they're not going to make money, that's net supply. Unemployment is a huge driver of this net supply over time. So if the unemployment rate begins to rise rapidly in the US, which I think is happening now, foreclosures and short sales hitting the market could have an unprecedented impact on the state of speculative demand. And that's not all. Some reports even suggest that the Fed may need the housing market to fall. Because the key difference between 2007 and now is that the Fed was far more behind the curve this time. In contrast to 2007 to 2008, when the government actively tried to help stabilize the housing market, the Fed is likely unable or unwilling to put any support under housing prices because they're overpriced and they can't unnecessarily waste money fighting the market. Buyers who are taking sellers' asking prices right now are enormously overpaying based on market fundamentals. This is why so few people are buying homes right now compared with the recent past, and why so many home buyers are canceling their contracts with builders. Like it or not, the 21st century real estate market has been a wild ride of a roller coaster, redistributing years and years of salary income to winners from losers. If you make a bad decision regarding housing, it can negate the earnings from a six-figure salary for a decade or longer. The market is speaking to us right now if you're willing to listen, and what it's telling you is that the unhealthy US housing market is in a twice-in-a-lifetime amount of trouble. Investors in housing-sensitive stocks like home builders should pay attention to the bigger picture with the real estate market and consider selling their positions as well. Now the question is, will this housing market crash outdo 2008? It's yet to be seen. A key reason behind the 2008 housing crash was a rise in the rate of unemployment. If unemployment stays relatively low, then home prices may just grind downward and get back up soon after. But if unemployment rises to 6%, 7%, or more, millions of motivated sellers will hit the market with relatively few takers due to the changing demographic reality of America and the amount of demand that was already pulled forward during the pandemic. And in 2008, houses were somewhat cheap, drawing capital in from institutional investors. If home prices were to fall something 10%, 20% from here, valuations would still be higher than fundamentals suggest they should be. Those declines would only take us back to 2021 prices, with rates dramatically being higher. Thus, this has the capacity to really outdo the crash of 2008. What do you guys think about this? Let us know in the comments below. Well, this brings us to the end of today's video. We hope you liked the video. If you did, make sure to hit the like button. And for more such informative videos, subscribe to the channel. And don't forget to press the bell icon to never miss an update from us. We'll catch you guys in the next one. Until then, peace.